The following script was written, verified, and approved by compliance professionals at financial regulation courses. FINRA Rule 3.26.0 governs discretionary accounts, customer arrangements where member firms or registered representatives execute trades without obtaining prior approval for each transaction. Superseding NASD Rule 2510, it establishes the regulatory architecture distinguishing legitimate discretion from unauthorized trading. The rule simultaneously prohibits excessive trading, mandates specific authorization conditions, and requires frequent supervisory review. Most recently amended in 2019 to clarify time and price exceptions, Rule 3260 remains a fundamental pillar of industry-wide investor protection. Rule 3260A strictly prohibits churning, which occurs when a representative executes transactions excessive in size or frequency relative to the account's financial resources. Churning harm is compounding. Commissions reduce account value, while high turnover creates unnecessary tax burdens. Compliance isn't mechanical. Examiners use cost-to-equity ratios and turnover rates to assess appropriateness. This standard aligns with regulation best interest, requiring broker-dealers to consider costs and alternatives. Even with explicit customer consent, representatives are never authorized to trade beyond what the account's character justifies. Under Rule 3260B, two conditions must be met before exercising discretion: prior written customer authorization naming specific individuals, and written acceptance of the account by the member, evidenced by a designated partner, officer, or manager. Verbal authorization is never sufficient and frequently leads to enforcement actions. This bright-line written requirement eliminates factual disputes regarding the scope of authority. Firm acceptance represents an affirmative determination that the arrangement is suitable for the client and that supervisory systems are adequate. If a representative leaves the firm or is reassigned, authorization does not transfer. A new naming document is mandatory before the new individual may act. Rule 3260EC mandates rigorous ongoing operational oversight. Principals must approve every discretionary order in writing promptly after entry. This is distinct from the initial account acceptance. It requires contemporaneous, order-by-order validation through electronic workflows or initialed order tickets. Furthermore, firms must review discretionary accounts at frequent intervals to detect patterns of excessive trading. Written supervisory procedures must specify these review frequencies and methodologies. Failing to conduct substantive evaluations rather than nominal sign-offs constitutes a primary supervisory failure under the Rule 3110 framework. This continuous oversight ensures churning is identified and stopped before significant capital erosion occurs, protecting both the customer and the firm's integrity. Key takeaways: prior written authorization naming specific individuals and formal firm acceptance are non-negotiable prerequisites. Time and price discretion is strictly limited to the current business day. Churning remains a violation regardless of customer consent. No amount of prior agreement authorizes trading that exceeds what the account's character justifies. Knowledge gets you qualified. Visibility gets you hired. Explore financialregulationcourses.com for professional memberships that combine verified profiles and QR code resumes. Our intelligent career tools are designed to help ambitious finance professionals stand out long before the interview begins. Join the industry's fastest growing community today.